Well, thank you, Alberto. Thank you for the introduction, and it's a real pleasure to be here. And it is fitting that the last speaker is one of the co-organizers, Shebnem. Maybe she can tell us what's going on with the lira. So this is a conference that, you go through the very rich and interesting papers, and it's importantly focused on risks to emerging markets, capital flow reversals, sovereign debt, currency risks. So I'm here to talk about the reversal problem. And first, of course, I will have to define what I mean by the reversal problem. But first, let me give you some historic context in the very areas of focus of this conference. We think of emerging markets now, and this has been reflected in a lot of the papers, as a group, as an asset class. But, in the 1970s and into the 80s, emerging markets did not exist as an asset class. They had existed as an asset class in the 1920s and in the 19th century. My work with Christoph Trevisch on sovereign bonds since Waterloo highlights that history. But the lending of the 1970s was entirely commercial bank lending, not really EM bonds. Portfolio flows and the like were non-existent. In the 1980s, they disappeared. The debt crisis of the 1980s disappeared off the face of the earth, the EM class. And you'll see where I'm going with this background. Then came the resolution of the 1980s debt crisis, the creation of the Brady bonds, and emerging markets having now securitized, the lending of the 1980s was securitized into bonds. EMs began to trade as an important and growing high-risk asset class. And the road was very bumpy in the 1990s. We had, the Mexican crisis and the spillovers of that crisis into particularly Argentina. We had the Asian crisis, which engulfed almost half a dozen countries. We had the Russian crisis. Colombia had its own crisis in 1998. And that decade culminated with the Argentine default at the end of the convertibility plan in December of 2001. And that chapter was finally closed with Uruguay's debt restructuring shortly after the Argentine crisis. And then what entered was a decade of comparative prosperity for many emerging markets. And this prosperity, which I will talk about, was fueled by a variety of factors. In Latin America in particular, high commodity prices play a big role. The fact that international interest rates were trending lower and lower also played a big role. And the global financial crisis, it was called the global financial crisis of 2008, 2009. It was called global, but it was really a crisis in about a dozen advanced economies, which had largely property bubbles and the associated financial sector problems. EMs, after a very turbulent period around the height of the crisis, the Lehman moment, recovered very nicely for the most part, with the exception of some EMs in Eastern Europe, and continued that relatively long-lasting period of higher growth rates. An important feature was the absence of major EM crises. And that began to change, which brings me to the reversal problem. Now, we have to acknowledge, the first thing we should acknowledge as economists is humility, because, economists are notoriously bad at detecting turning points. And I think we are at a point in time in which there are questions of whether we are entering a turning point for many things, including emerging markets. Can you all see the full chart? Because I can't. Can you see 2020 in this chart? Yes or no?
Yes, we can. Yes.
Okay, very good. Look, emerging markets began to, the golden decade began to wear off around 2015 with a sharp decline in commodity prices, a big slowdown in China, and EM growth rates began to falter, and debts, external debts, domestic debts began to build up. But in this setting of weakening fundamentals enters the COVID crisis. What this chart shows is the share of countries that had an output decline on a given year. And that share of countries having an output decline during COVID, at the peak of COVID in 2020, was a whopping 90% of countries. 90% of countries recorded declines in per capita income. This, as you see from here, is bigger than World War I, bigger than the Depression of the 1930s, and bigger than the 1980s crisis, not to mention, of course, World War II. So what is the reversal problem? The reversal problem is a theme that I've been working on in the recent past in my time at the bank, which is, are we seeing a temporary pause in this trend towards better outcomes in emerging markets, or is this more serious? Does this have big scarring effects? And this, of course, has big implications for much of the discussion that we've been having in this conference. The growth rates, as I mentioned, have come down. The incidence of sovereign debt crisis has jumped up, especially, but not exclusively, in low-income countries. In low-income countries, for example, out of the 73 countries, low-income countries that are eligible for the Debt Service Suspension Initiative, the DSSI, about more than half of them are either in debt distress or at high risk of debt distress. Within the EM space, we have, of course, Venezuela, we have Lebanon, we have Argentina, Freudian slip. We have, the smaller countries that one seldom hears about, like Suriname and Belize. And we had Ecuador with the restructuring alongside Argentina in early 2020. In other words, we are not in the tranquil waters of that pre-2015 decade. And so for the discussion of risk, I think it's appropriate to start. These risks, by the way, are encapsulated in what has been an important reversal in the convergence trend, not just in per capita incomes that I mentioned earlier, but in sovereign credit ratings. In the decade after the years immediately after the global financial crisis, what we saw was a simultaneous downgrade in many sovereigns in the advanced economies, notably Europe. And while at the same time, many EMs were being marked up. This has dramatically changed in the last 2 years, and we are concluding the second year of COVID now. So the question is, again, is this a transitory phenomenon or something that is more permanent. Perhaps permanent is, few things in life are permanent, but many of them can be quite persistent. And the hypothesis that I will try to convince you of in the next in the remainder of this conversation, which I hope we can continue during Q&A, is that a lot of the changes that have occurred even before COVID, but certainly accelerated during COVID, make some of these changes more lasting, more permanent. And nowhere is that change most visible than in what's been happening with inflation rates across the globe, advanced, emerging, and within emerging also middle income, and of course also the low income. And of course, a reversal in inflation, if it turns out to be more persistent than transitory, also means a possible reversal in interest rates, which of course, importantly, the financial cycle, the global financial cycle, as has been identified by many papers, some of my early work with Guillermo Calvo and Leo Lederman, and much more recent work by Helene Ray, Pierre-Olivier Gourinchas, Maury Obstfeld, Kristen Forbes, and the list goes on and on, Frank Warnock. They have documented the importance of these financial global cycles. So the theme that I would like to continue on is therefore this reversal problem in EMs and the widening gap with advanced economies. What this chart shows here is a very simple comparison. You take the World Economic Outlook data for October of this year, and you ask a simple question, which is what share of countries have been able to recover their pre-COVID level of per capita income? That's the top panel. The answer to that question is that about 41%, 40.5% of the advanced economies, 2021 is at a peak. It's higher than 2019. By the time you get to the middle income countries, that 41% becomes 28%. By the time you get to the low income countries, the share of countries that have actually been able to recover to pre-COVID levels is only 23%. Now, remember, I already said that a lot of the problems in EMs and low income countries started well before COVID. And it started importantly with a commodity crash of around 2015 and the slowdown in China. So if you look at the lower panel, the share, and you do the same exercise, except you compare 2021 and ask yourself, is 2021 a global peak? Not is 2021 higher than 2019, but is it a global peak for per capita income? And the answer is, for advanced economy, for a little over a third, 35% of the countries, it's 2021 is a global peak. For the EMs, the middle income is 21%, and for the low income is 12%, which means that the overwhelming majority of countries in the EM and low income space are doing not only worse off relative to where they were, but much worse off than the advanced economy counterparts, which also raises issues of what is this asset class? What are the risk factors for this asset class? And the risk factors are likely to persist well into next year. I'm going to go fairly rapidly through some of these and in more detail in others, but what this chart shows is that financing needs, budget deficits. This is the countries that have deficits in excess of 5% of GDP. That share has spiked, and what is more telling is that because COVID is still circling the globe with new peaks, fresh peaks happening in Europe now, and no sign of whether that European peak is going to travel to the Western Hemisphere once again. Financing needs are likely to remain quite elevated. So you take slower growth, big financing needs, big deficits, and a significant debt buildup. And remember, if you look at EM debt levels, they're at levels that would look very modest, very tame by advanced economy standards. But I would like to remind everyone of some work that I did ages ago with Miguel Sebastano and Ken Rogoff called Debt Intolerance. Debt intolerance is about external debt, but it's more generally applicable to both external and domestic debt. For EMs, debt levels are already at surpassed the levels of what ushered in the debt crisis of the infamous debt crisis of the 1980s, otherwise also known as a lost decade in Latin America. Now, where am I going with this? These are these reversals, again, and they are big reversals, transitory, or are they signaling that we're entering an era of much higher risk levels? Perhaps not quite the drama of the 1980s, but perhaps a much more volatile stop and go period of the 1990s. Commensurate with that rise in debt, what this chart shows is a very sharp pickup in debt servicing, as debt servicing taken to be both principal and interest paid. Here shown, this is only for external debt, as a percent of total exports of goods, services, and primary income. Basically, since 2010, in which debt servicing accounted for about 10% of exports, it is now doubled. This is only 2020 figures. In 2021, on the basis of what's been coming in, it actually looks even worse. And for comparison purposes, I've shaded in the period in which we had a significant share of countries, more than a fifth, in default. The risks are not only thus from lack of recovery. I've always highlighted, do not confuse rebound with recovery. Rebound is about a big snapback after record-breaking declines in many cases in 2020. But recovery is about being at least as well off. This is my first table looking at per capita GDP. The picture is also complicated, as I said, not just by imperfect or lack of recovery, larger financing needs, higher debt levels, both domestic and external, higher debt servicing costs, and the more recent entry into that catalog is rising inflation. And actually, I didn't have an opportunity to update this through the very latest numbers. So this is only about a month lag in these charts. But the share of countries with inflation rates that have climbed back, among the most modest 5% level are the overwhelming majority of EMs, and a very significant share for the advanced economies. But the more troubling chart, perhaps, is that the more extreme cases, countries with inflation rates above 40%. This is now extreme. This is, melodramatic to call it, doesn't meet quite the criteria of the Kagan hyperinflation, but it certainly goes in that direction. That share has also increased dramatically. Collectively, this raises obviously two questions. What happens as global interest rates begin to climb out of historic lows? And by historic, I don't mean historic since 1980 or since, I mean historic. I mean, if you look at 200 years of real interest rates during the COVID crisis have been at record lows. And yet in the world's largest economy, the US, the inflation rate now at 6.2% on a 12-month basis is climbed out. The CPI is at its highest level in 30 years, and the producer price index is at its highest level in 40 years. So many of the risks that have been discussed in the various papers in terms of does this spell a capital flow reversal? Does this spell more currency crashes? We're having one today in Turkey. Does this spell more sovereign problems? Remains to be seen. But I didn't mean this to be a real downbeat, but it really is hard to be uplifting at the moment. So let me continue on that downbeat path. When credit ratings and investors assess risk in EMs, obviously they look at very much the same macro indicators that I've been discussing now. But they also, the bigger picture, which is how emerging are the emerging markets, is also subject to the reversal problem that I've alluded to. The reversal problem is also evident in global poverty rates. If you look at the World Bank most recent, I am now involved in the next cycle updating the poverty numbers, but if you look at the most recent published late last year, global poverty rates for the first time in 2020, for the first time had a spike, an upward spike since 1998. That's another part of the reversal problem. This is definitely complicated by the fact that many of these issues that I've been addressing, per capita incomes, fiscal corrections, it's easier to destroy quickly than to build, which is usually more gradually. So building up debt is faster, but reversing it takes more time. Reducing poverty is slower, but reversing it took only a year, and so on. So again, I want to hark back to the big question of, have we entered a turning point? Because, and this is really important for the policy discussions, because on the fiscal side, the policy discussions, especially but not uniquely in the advanced economies, the policy discussions have been centered on a declining path of international interest rates. On the monetary policy front, policy has been set under the assumption that inflation has been trending lower, has remained low, and relatively stable in the majority, certainly in the advanced economies, and then in the majority of EMs. And of course, a big question is, are we seeing in the post-COVID, as part of the post-COVID legacy or scarring, as it's often referred to, are we seeing a reversal? So apart from the macro picture, poverty is an issue, but it doesn't stop there. Inequality, if you look at the breakdown of income loss, breaking countries down by quintiles. Income losses have been most significant in both 2020 and in 2021 for the poorest countries. So not only is COVID been regressive at the cross-country level, which goes back to the table on per capita GDP that I showed earlier, it is also been regressive within countries. And so this is complicated, right? Because if you're also talking about a lackluster macro performance with a larger share of vulnerabilities, and you are also looking at so you have a shrinking pie, a pie that's distributed more unevenly, and rising poverty, that also sets the stage for social setbacks of the kind that spill over from strictly the economic dimension, which I've been talking about, to the political and social unrest. So I will conclude my presentation with one more slide, also suggesting that there is reason to believe that some of that the reversal problem is going to be a big issue for emerging markets going ahead. And my final slide has to do with human capital, which is also something that the World Bank spends a lot of time trying to measure, understand, and assess. Learning was more severely interrupted in the lower income countries. The return to schools post lockdown is much more uneven, much more skewed away from girls. So also gender issues, by the way, have also been reversed, not just in education, but in poverty rates. That the new COVID poor is increasingly urban and increasingly women. So the thing about human capital is that it carries over from one period to the next. That is to say, it has bearing, as we all know from the large body of literature on linking human capital to cross-country growth performance. So as I said, I have been, very much sounded a downbeat role on this in my remarks. But this is a conference that has carried over for 2 days on the issue of risks. And so the message that I would like to leave you with is twofold. One is not just the macro risks, there's a whole host of reversals going on at the micro level. And importantly, both the macro risks and the micro risks are not easy to reverse themselves. And I think a big open question, which feeds into the reversal problem, maybe we can get to during Q&A, is the issue, will the reversal problem lead to a reversal of policies, as they did in many cases during the 1980s. So I could not congratulate the bank more on choosing a better topic for not just the now, but for the future in EMs than how to assess risks and perhaps contend with a period ahead in which EM risks moves back the pendulum to some of I'm not talking about the 1980s, but much more the incidence of crises, the incidence of capital flow reversals, the incidence of currency crashes, returning with greater force as we look ahead. And on that uplifting note, I will conclude.
Thank you very much, Professor Reinhardt, for your very illuminating, or not uplifting comments. While we wait for questions from the audience, I would perhaps like to make a brief comment. I would like to learn your views on some aspects that interact or perhaps give a background on the issues that you raise. One which has not been mentioned in this conference, perhaps, is the issues related to climate change. So I just came back from COP26 actually, and I was in these panels where all the ministers of economy and the environment congratulate themselves on all the great achievements, and then you go to the science panels, and you get completely depressed, and they show you the maps
Yes.
on the expected effects on climate change on different dimensions, and it's incredible the correlation between how adverse the effects are expected to be and the initial per capita GDP
Yes.
levels of countries. So the worst region by far is Africa.
Yes.
The second worst region is East Asia, so Bangladesh, countries like that. So for me, that spells that's another issue, which is we really have very little uncertainty. I mean, this stuff is coming in 5 or 10 years, and together with the outlook that you present us, this for me spells a very strong push towards significantly increased migration in the next 5 or 10 years. So I don't know. I would like to hear some thoughts from you on that issue.
Well, it's a wonderful question, and I'm glad you asked it. I did not. So the climate picture comes in many forms. It's incredibly relevant. Number one, you remember the chart that I showed on budget deficits and financing needs. Well, climate finance adds another layer to those already high financing needs because in the end, the transition to decarbonization is going to require capital flows from north to south. And it's going to require not short-term hot money. It's going to require long-term finance because a lot of that trajectory doesn't have immediate payoff. So these are not your carry trade kind of transactions. So it adds yet another layer of complexity in terms of financing needs. On the issue of migration that you mentioned, it is indeed. But think of the issue that you raised that very accurately paint a picture in which climate risks are also very regressive. By the way, this year's World Development Report is focused on financial fragility, so it also addresses many of the issues that I've talked about here. Next year's World Development Report is on migration, including climate migration. Now, for assessing risks, I mean, there are already articles out there saying, look, credit rating agencies have yet to internalize how you price climate risks into sovereign risk. Okay, but from the very accurate depiction, by my understanding, that you gave, what it means is that some of the countries that are already either out of capital markets will remain out of capital markets, but there's also a big chunk of countries that, during the golden days of capital flows, these were the frontier economies, including Bangladesh, that were many of them able to place bonds at very favorable rates by their historic standards. And this adds another layer to the sovereign risk question. So if anything, Alberto, the issue you raise adds to the two themes that I said. One is, the risks are manifold. I mentioned macro and micro. To add to that, you can add climate, and that has both micro and macro aspects to it. And you can certainly say that it is persistent. I mean, this is not a quick reversal issue. But these are areas that, as I said, the next WDR for 2023 is squarely focused on the migration, important south to south, but also north to south, and much of it associated with the climate question.
Thank you very much. We have a question by Fabricio Perry.
Yeah, can you hear me?
I can hear you.
Oh, hey, Carmen. Thanks. Great.
Hi, Fabricio.
Great lecture. Yeah, I agree with what you said, but I'm a bit puzzled myself. I mean, I work at the Fed. We keep talking, oh, inflation is coming, but you see low interest rate being low, 10 years being low, and we see issue in probably, as you say, reversal, climate change, but we see the stock market going like there's no tomorrow. So it's like this a little discrepancy between the financial side and the real side.
You got it.
I just wonder what were your thoughts on that?
It's a question I've been asking myself for some time. Okay, so look, and I'm not going to offend you because my husband worked at the Fed for 25 years. So, you know, it used to be on the equity market. It used to be the Greenspan put. Then it became the Bernanke put. And now it's a Fed put. And let me, when I say that I expect higher interest rates going forward, I want to be very clear that I think central banks, the Fed will move quicker than the ECB, but in my view, it will still be following markets rather than leading them. Meaning this is more like the 1970s, okay? You know, I talked about humility and turning points because it's very relevant. You know, monetary policy has been conducted in 30 years now under the assumption, you know, that inflation is tame, inflation expectations are relatively anchored, advanced economy, inflation, you know, converged at its lowest levels. And then we had the global financial crisis, lo and behold, massive monetary stimulus, big expansion in the Fed balance sheet and in all the balance sheets of the central bank, but no inflation followed. So now I think we extrapolate, right? There is a sense that, yes, we had an even bigger expansion in the central bank balance sheet during COVID. But a big difference between the aftermath of 2008, 2009, and the aftermath of COVID is we didn't have supply shocks after 2008, 2009. Okay? We have supply shocks now. And I think that they're not relatively easy to measure as they were in the 1970s, in which you could point your finger to OPEC and say, okay, that's your supply shock. Now they're very complicated supply chain stories, mismatches between workers and worker demand. But you asked me also about this disconnect. And my sense is it's become somewhat circular. Monetary, I've made the point, I did this in my Carl Brunner lecture last month, that central banks may not have lost independence de jure, but de facto, I think they're working with their hands tied. You know, leverage is very high, both public and private. So I think the capacity to raise interest rates aggressively or very quickly is constrained by concerns about financial stability. Who wants to be the Fed chair that pricks the equity bubble? Okay? Who wants to be remembered for pricking the equity bubble? And yes, price earnings ratios are way out there. So I think financial markets also anticipate a more gradualist, you know, and again, the idea that fiscal policy has been dominated by, you know, Olivier Blanchard, you know, rates are trending down, R minus G works in our favor. On monetary policy, it's been the downward trend in inflation. If that works fine, if extrapolating works, but if we're at a turning point, we have a problem. But I do not think that financial markets are pricing in a Paul Volcker moment. Let me put it that way.
Thank you.
Andres Fernandez?
Yes, Carmen, hi. Thank you so much for this great lecture. I always admire you for keeping our radars sharp in terms of what are the risks around, and I can't think of a better way to close the conference. So we've talked about stabilization policies a lot in the conference, but not directly about bad policies, and why not call them by their name, populist policies, which it seemed to me that you referred to them at the end. So my question is, to what extent do you see this grim picture that you're painting as a fertile ground for populist policies, similar to what we had several years ago? And how would that reinforce this vicious circle that you're painting? Thank you.
I am really, I can honestly say these have been fabulous questions. And I did allude to the end, because the reversal problem is about shocks that happen to countries, right? You know, that you first had a commodity price crash and the slowdown in China in 2015, and then the COVID shock globally. They're not self-inflicted, if you will. They're not about policies that, and the answer to your question, Andres, my sense is that's why I also wanted to bring in, importantly, the issue on poverty, on income distribution, and on education, because the combination, if you have, you know, poor income distribution by historic standards or by cross-sectional standards, or, you know, a poverty issue, but the pie is growing rapidly, it works against the populism. This is a very fertile ground for populism and for more extreme kinds of policies. And this is not a hypothetical. This is, you know, we saw that, plenty of that, in the worst moments of the 70s and 80s, not just in Latin America, but across the board. I mean, my colleague at the business school, Laura Alfaro, has also written about reversals in openness in both. We were discussing capital controls, but also a very different kind of capital controls also emerges in bad times, not macro-pru kind of capital controls, but other. It is fertile ground. I would note, importantly, which I've left out of the picture, so I didn't finish depressing everyone. Now I have another opportunity, is bring up rising food prices. So the rising inflation has been accompanied in many countries with big relative price increases in food. This is the most regressive of taxes. So there is a geopolitical dimension that is also embedded in the reversal problem, which is, is the reversal problem caused by relatively exogenous factors followed by a reversal problem of its own on the policy side? And I'd say, you know, certainly the setting, the current setting tends to amplify those tensions. I would point out to the Arab Spring. It was importantly, you know, big hikes in food prices, very regressive, you know, impacts. And again, I wanted to share with all of you the concerns that I have on the risks front. And they certainly extend beyond the economic.
Oleg Itzkogi?
Hi, Carmen. I enjoyed the lecture a lot. So it's a somewhat related question that I had. So if you look at the data, and classify countries into free, partially free, not free. The amazing trend to me is that more than half of world GDP would be produced in countries that are not classified as free in terms of media, political system, and so on. Obviously, the trends are somewhat different depending on which index you use, and much of this trend is accounted for by China. But I'm kind of curious if you view this trend as, us entering into a sort of new regime where more than half of the world would be not the, in terms of GDP, would be not the typical Western type democracies, but to some extent authoritative countries. And so does it change the game in any way? And in particular, if you think about, China was great, arguably for relief of poverty in the world, right? Like 300 million people exited poverty because of Chinese developments. That's why it's not immediately obvious. The other thing that's not obvious to me is it something to worry about, or this is just, a red herring? But I'm kind of curious your perspective on this in general.
So importantly, one thing, Oleg, when I looked at, say, advanced economies, middle income and low income, they weren't GDP weighted. So it wasn't dominated by, China. This is just a straight share of. Look, I think what the reversal problem highlights, and I don't want to make the jump of characterizing half the world or, close to half as falling back on non-democratic, and I don't want to. I that's beyond my understanding. That's the honest answer to your question. But I do think that if you look at all the indicators of convergence, it's true. Convergence was disproportionately, highlight, by the fact that some like really big countries, not just China, but also relative to China, everybody's small, but not just China, but Korea and even notwithstanding the 1998 crisis, Malaysia, Thailand, a number of Asian countries in particular were gaining ground, and Chile certainly has also been a country that's gained ground and been part of that convergence mode. But the 1980s was dominated not by convergence, but by increasing divergence. And if you date the and again, I am not making the parallels with the 1980s, big dramatic domino effect, of one crisis after the other. I'm not making that parallel, but I'm making the parallel on the stagflation side, if you will. One thing I didn't mention, and again, I really don't want to go on your question on democratic versus non-democratic with a 10-foot pole, because I don't know the answer to it. But this also feeds back into the earlier question. If you break countries into quadrants, you do a 2x2 matrix on where are you relative in both inflation and per capita GDP, or inflation and unemployment, the misery index. The largest representation is in the quadrant where inflation is higher and per capita GDP is lower. Inflation is higher, unemployment is higher. So it goes in the direction of that bigger divergence with the advanced economy that still have a lot of firepower. I mean, we're seeing that not in the EM space, the firepower in monetary policy is already quickly eroded with a lot of central banks hiking rates as a response to, rising inflation and currencies and so on. On the fiscal side, similar, pushing the edge on fiscal space. So there is this greater scope for, as we were discussing also earlier, more polarized systems, disproportionately, but not exclusively, in the EM space. But I'll leave it at that.
Okay, so do we have more questions to Carmen? All right, okay, so Carmen, thank you so much for this excellent keynote. We really appreciate it.